my idea is to talk a little bit about what we do, and also to kind of go through a bit of an example of one of our projects in a bit more detail. So kind of first off, who am I? So I lead a team of data scientists here for Aviva in Canada. And we pride ourselves in building what at least we believe are kind of best-in-class models in a variety of areas of the business. I originally joined Aviva back in 2013, so just coming up to 8 years now in the company. Originally from the UK, which some of you might recognise from my accent. Working in the pricing departments and more actuarial science before transitioning over to analytics and data science. So yeah, kind of background is mathematics, and also in my spare time, or at least when I had it, was quite keen on Kaggle. But a fun little bit of kind of fact about me is I wasn't always destined to be a data scientist. In fact, I started off life being a bit more art student, and what was in fact at art school, and had some work published, and suddenly woke up one day and decided that I needed to do something different with my life, and changed across to mathematics. So that's kind of a bit of an introduction to me, and if there's any questions that we don't get to tonight, then feel free to reach out to me on LinkedIn or directly on my email. So I wanted to talk to you a little bit about what insurance is and Aviva to start with, because some of you may or may not know that much. So Aviva is a global insurance company offering personal, commercial, and life insurance. Here in the North American market, in Canada, we predominantly are in the personal and commercial lines, with over 2.4 million customers across the country. The data science team here in Canada, and we're based across Ontario and Quebec, is currently around 50 members, and we're kind of split into three main pillars. So we've kind of divided ourselves up into what we call our model acceptance teams, our data science teams, which is where I work, and our kind of more engineering focused teams. And we also have a kind of a strong link kind of globally across Aviva with our data science functions. Altogether, Aviva has around 500 members in data science and related fields across Europe, Asia, and North America. So we have a really rich, diverse kind of eco-structure that we can kind of call on, and it's always useful if you can't solve a problem in our own team. There's probably someone who's already solved it in a different country. So probably focusing mainly on personal insurance tonight, so auto and home insurance, just for kind of where my most experience is, and probably also where some of the more interesting problems are for data science. So for those that aren't too familiar with kind of the concepts of insurance, insurance is basically kind of taking away the uncertainty of some big risk and turning it into a smaller monetary value. In its most simple form, we can imagine that insurance is basically summing up everyone's potential risk and dividing that amount amongst all the members equally. So, we can imagine that there's three of us and our combined potential risk. So let's say we all have a sum of money or some item. And if all three of those items were lost, then the total amount would be $900. So the basic insurance idea would be that we'd all pay $300 in, and then if any of us lost our insured item, then the kind of combined amount of money would pay for that loss. But not everyone's loss is the same. What if you don't make a claim? What if you're much less likely to make a claim? What if the value of the item that you're putting in the pool is much larger than someone else's? So this is really where kind of data science comes in to proportion this risk. And this is probably the key element of data science in insurance. But it's kind of much larger than that. So this is kind of the surface high level look. Okay, so, you might have heard me at the beginning talking a little bit about actuarial science. So data science to insurance is relatively new. So like a lot of industries, data science has become the new kind of in buzzword, particularly for insurance. And over my last 5 years, I've been in teams that have branded themselves initially as analytics, data transformation, and nowadays data science. But really, kind of, we're doing similar roles. So the insurance industry traditionally kind of looked at these problems of sharing risk, and this was generally done by actuaries. And this kind of approach was pretty simplistic in the early days. And we're talking about kind of looking at one-way analysis, univariate analysis. You know, if my item is worth twice as much as your item, then the amount I should pay should be twice as much. This kind of developed, and you start to see the use of linear regression and predictive models, multivariate analysis, and particularly as you go through the later half of the 20th century. So from the 1950s onwards, the use of things like GLMs and linear regression explodes in the insurance industry. And then kind of from there, the kind of the complexity of these models and the scale of the problems kind of accelerate to the point where we see in the last 10 years, kind of analytics have really come to be the driving force in the industry, both for kind of looking at the pricing problem, so how much to charge a customer, as well as things like how to make customer experience better, chatbots, NLP, claims and fraud. So kind of data science in kind of general isn't kind of replacing the role of an actuary in an insurance company. Instead, we kind of see ourselves as working alongside and kind of extending that tool set. So, you know, the kind of data science kind of is enabling insurance companies to kind of leverage kind of much more advanced techniques that perhaps traditionally haven't been used, and approach problems in a kind of different and more creative way. So kind of, you know, we've talked about the simple problem of risk and pricing and in kind of a very high level. And, you know, when it comes to insurance companies, a lot of people feel that our main focus is just that. You know, we model how much to charge a customer. So I kind of wanted to talk a little bit and show you a list, and this is only a small list of some of the items that our team kind of works on a day-to-day kind of process. So, you know, we look at geographic models, so looking at a variety of problems in a geographic space. So maybe this is looking at rainfall and flooding over an area around a river, etc. Or maybe it's a bit more high level, so looking at crimes and the impact on business and our customers, maybe by postcode or by FSA. You know, we also do that traditional thing of calculating price, but we look at kind of what's a customer's chance of claiming, what's the size of their claim going to be. So, you know, just going through that types of problems and just the modeling there alone can get very complex. And then kind of so many more examples that I'm not going to go through every single one, but I'll just pull out a few here. So, you know, whether it's looking at things like predicting market premiums. So here it's less about predicting our customer's price, but predicting what our customers are likely to be paying our competitors. So, you know, understanding our business, are we competitive as well as producing a good result for the business? Looking at churn, you know, why are customers leaving, and can we predict a customer that's going to leave and return as a new customer? Can we predict the coverages that the customers want? You know, can we suggest to them, you know, we think you're going to need these coverages and make that process easier for them? Perhaps one that's the most topical right now is catastrophe modeling. You know, we're kind of a gambler's business in the way that we're trying to predict events. Some of these events might be 1 in 5 year events, but sometimes those events are very rare. Things like pandemics. Can we, or extreme weather events, can we, you know, predict better the likelihood of those occurring and prepare for them? There's obviously keeping customers. How do we retain customers and kind of acquire that business? Acquiring new customers can be expensive, and we much prefer to reward our loyal customers that choose to stay with us. And then there's things to improve kind of customer journeys. So can we give customers decisions quicker on their claims? So in insurance, the big example that a lot of the larger old insurance companies like to point at to be their kind of poster boy of where they want to get to is a company called Lemonade. So they do insurance on kind of small technology items like laptops, phones, but they pride themselves on, if you make a claim, then they can pay out that claim within 10 seconds, I think was their fastest claim payment. So it's all around kind of automated decision making, and can we identify the customers that are suitable for that kind of action and speed up that journey. And then obviously with any financial institution, there's plenty of looking around kind of claims fraud, and people do make claims that they shouldn't, and financial fraud as well. So just kind of a bit of a talk about kind of our team, kind of what we use. So we're predominantly Python developers. So we kind of our IDE of choice is PyCharm. We support that with kind of the standard version control and project planning software that is kind of industry standard. So Bitbucket, Confluence, Jira. And then we use compute servers for running our jobs. So we're lucky enough to have some GPU servers as well as some large CPU servers, and looking at migrating into AWS. So that's kind of a very brief overrun of our team and kind of some of the areas that we look at on a daily basis. But to be a little bit more interesting, I thought it'd be interesting to go into a specific example. So being in, thinking this was fintech, I decided to try and pick one of our more complex models. So this is actually an example from the UK. It was a live model in 2017, but since then has been updated a number of times. So just to give you a bit of background around the UK insurance market, it's a little bit different to the North American market in the way that, so a few things. One, the UK insurance market is probably one of the most analytically advanced in the world. It's also the fourth largest market in the world. And per capita, it's probably much larger. So kind of the capita size of China and United States is much larger than that of the United Kingdom. Because of the market, the major insurance carriers all have very sophisticated pricing ecostructures. These have been built over many years. So to deliver a price to a customer, you might think is one model, maybe two. On average, it's probably more along the lines of 50 plus models to produce a price for a customer. And there's a few reasons for this. One is that all of the competitors are, these large insurance companies, and these are kind of the big five in the UK, are very kind of competitive with each other. You're in a business where market share is very important, and kind of losing or gaining kind of 0.5% of market share is the difference between a good financial year and a bad financial year. On top of that, your customer base is also very price sensitive and very well informed, both from industry and consumer information. So customers in the UK generally shop for their insurance online. That they're not a broker business. So you're not going to someone and having a chat over a coffee and getting your insurance policy, and maybe takes half an hour. In the UK, the market is very much more about being quick, about being online, about little to no interaction with anyone. It's a market where brands are pushing the fact that you can do a quote, pick your insurance and purchase that insurance and move on with your life in under 5 minutes. There's a big push about asking no questions. So using third-party data to complete those questions. So as a customer, you don't need to give as much information. And also at the same time, still providing the absolute lowest price that is possible. So this means that in the UK markets, their pricing is very competitive. So you've got a very competitive market with hyper-personalized pricing. And this means that not only do we have to price a customer, we also have to run price optimization. So similar, if you think of airline pricing is a traditional example. If you search for the same flight a few times, you see the price changes every time you search. You'll get similar kind of effects happening in the UK insurance market. Customers, as I said, are generally interacting through an online process, particularly in motor insurance, and more so than that, they're tending to use third-party aggregator sites. These are sites where you can answer your 10 questions, and then rather than presenting you with one premium, they all go away and present you with premiums from 50 plus different carriers and order them by price. And this further feeds to the fact that customers are price driven, so they're just going to what would be referred to as top of screen. So the image on the right here is an example of an insurance quote I did on a UK aggregator a couple of years ago. And generally the customer process is, I'm just going to pick the top quote. That's the cheapest price, and there's no need to move down the list. So, how do we, as a business, ensure that our quotes are appearing at the top of that list, while also kind of maintaining a profit margin, so that we're a profitable company? So that's kind of where we start to get into price optimization. So I really want kind of, if we think of optimization in its most simplest form, we're going to imagine that we've got some policy, and as the price increases, our profit for that policy increases. And by policy here, this is your insurance. So let's say you're insuring your car. The more you pay to insure your car, if there's a fixed amount that I need as what I think is your underlying cost, anything more than that is profit. So we can imagine that as the amount you pay increases, obviously the amount of profit as a company will increase. But that's kind of counteracted by the fact that the likelihood of you purchasing that policy decreases as that price increases. It's important to note that the customers' conversion rate generally isn't linear. So at a certain point, it will drop off very rapidly as price gets over a certain point, and certain customers are more or less sensitive to that price point. As well as in the initial stages, small increases might have little to no effect on a customer's likelihood to purchase. So what we want to optimize is the combination of these two. So can we optimize such that we convert enough policies that we're writing business, while also ensuring that we make a good profit, so that we keep shareholders happy, and we also have our returns at the end of the year. So we can imagine that for every kind of customer, we can generate some sort of expected profit line. And this is kind of looking beyond the term of the policy, but looking more at the lifetime of this customer. So maybe the expected profit is higher for a particular customer because we think they might buy other insurance products, or maybe we think they're going to be a loyal customer and stay with us for a long time. So in the insurance optimization problem, we'll look at where they initially sit on this line. And basically, we want to optimize to move their price to a point that kind of moves them to the top of this curve. So we're always trying to get to the peak of this curve, and this is your basic optimization problem. So in the example here, we ascertained that the easiest way to do this is we needed better information about our competitors' premiums. So we looked specifically at our market model. So we get a certain amount of data around market premiums, and we wanted to predict that better. But let's just look at the eco structure. So what goes into generating our optimization strategy. This is kind of simplified. Overall, this is much larger, but we need some sort of expected cost. So how much is that customer going to cost us based on their historical performance? What do we think their loyalty is going to be? What do we think the market premium is going to be to that customer? So do we feel we're competitive or not? That all goes into what we call our customer value, and eventually into our expected profit line. So as we were saying, we were looking at the market premium. So, due to the competitive nature of the UK market, we decided the best way to improve our optimization strategy is by understanding our competitors better. And the big reason for this is predictive competitiveness. We want to know where our initial kind of price to a customer sits compared to the market. Are we in the ballpark or are we miles away? Which customers are the best ones to target, and which ones, are just not in our underwriting footprint, which ones are we just not used to writing. So just being aware of time, traditionally these models are kind of very linear, but being a data scientist, I looked at the problem here, and we're trying to predict the average premium of the market. We get this from consumer information. It's anonymized to an extent, and also it's an average of the top quoting insurance companies, and we don't know which insurance companies those were. So we're usually looking at the average of top 5 or top 10. So traditionally these have been built with linear models. So a little bit of maths here is that, because at this time, most of those cost models would have been linear regression models, we'd expect the combination of linear regressors to be linear. We'd also expect that, because most insurance companies are using GLMs, so generalized linear models, the link function does add a certain amount of nonlinearity. But where we thought that the biggest benefit is that, unlike other insurance companies that were continuing to use GLMs, we identified that when you're looking at an average price of top 5, and those insurance companies are going to change policy, you're not actually looking at a straight average, and the target becomes highly nonlinear. You're actually looking at the bottom quartile of a set of models. There is a lot of maths that I don't have time to go into here, but if you're wanting a bit of an introduction as to why this is the case, there's a short but interesting article written by Joshua E. Hill, The Minimum of N Independent Normal Distributions, that covers this. So kind of where we got to with the model is by identifying that it was really nonlinear, we replaced that model with a gradient boosting model that kind of drove a kind of a 6% improvement. Some people might be thinking 6% doesn't sound much, but in a market where $50 can be the difference between being one of the top 3 and writing a customer's business to not being competitive at all, so out of the top 10, out of the top 5, 6% was very significant. And we were able to improve the optimization problem considerably with that new model.
Yang said, broadly speaking, in terms of prediction of future events at the same time scale, using big data among all the models you are familiar with, which general type of events are typically accurately predicted? Which type of events are very poorly predicted despite wrong financial incentives to predict well?
Yeah, so the big one for insurance, and particularly motor insurance, is bodily injury claims. So they're fairly difficult to predict at point of quote, but they are kind of the significant element of all of our costs. And by bodily injury claim, this is kind of injuries to third parties involved in an accident. So they're the ones that, if you can improve that model by a very small amount, you can make significant benefits for the company.
Most insurance companies are still at the GLM stage using aggregated data. Does Aviva plan to apply or develop any machine learning models on individual claims, reserving data instead?
Yeah, so you're right. There's the industry is one of kind of two halves. There's a few industry leaders that are pushing for kind of more advanced ML techniques, and those that are still using GLMs. And GLMs are still very good for a lot of the problems. When it comes to reserving, again, similar to kind of the risk modeling and customer modeling, it's advancing and it's kind of hand in hand. So our team perhaps doesn't do quite as much reserving, but we do work strongly with the reserving team who are using a lot of these techniques to advance their modeling there. The problem's a little bit different, but the techniques can still be utilized and give good benefits.
How important is models interpretability versus accuracy at Aviva?
Yeah, so it's absolutely key. So particularly in the North American market, where we're kind of regulated by province as well as kind of at a federal level. So certain provinces require different things. So internally, we have to be able to explain all our models, whether we're using the most advanced neural network or the simplest linear regression. At the end of the day, I still need to sit down and explain that to my MD, and he needs to be comfortable with that before he'll let that go live. So there's as much work as we do on models, we do the same amount of time probably on model interpretation, and that's really why you see that whole model acceptance pillar in our team structure there.
Can you talk about current utilization of blockchain in insurance industry and what kind of trends are you seeing in this area?
Yeah, so it's an interesting one that is certainly being looked at. I think it's going to be more in the back end than necessarily something that's going to impact a customer's price. It's perhaps something that I'm not strongly kind of associated with to be able to speak on it much. I know that many insurance companies are looking into how they can utilize the technology. I think a strong use case is still kind of not apparent in every company.
Siddharth has asked, when I was working at AIG as a CAT modeler, I realized predictive analytics is a bit difficult to implement in commercial property and energy engineered risks, as there is a lot of statistics involved. Are there any areas of insurance where we can accurately use predictive analytics?
Yeah, so I would say that certainly our team is encouraging the Aviva and Canada to be much more data driven and using predictive models and predictive analytics in all areas. Certainly, some of those areas are more of a challenge than others, either due to data quality or kind of data quantity. But as of yet, touch wood, that there hasn't been an area that we haven't been able to find a solution for the business that we've been involved with. And that includes commercial property, where we have some existing models, and we're always looking at improving on our models all the time.
Eric has asked, when you build your regression models at Aviva, what are some of the most common variable transformations?
Yeah, so it depends on the model's use. So the first question is kind of, how regulated is the model that we're building? Is it something that's going to impact kind of a customer price, or is it something more of a back office model? In which case it kind of depends on what you can do when it comes to feature engineering. So if it's a model that's more for information and reporting, then sky's the limit. We'll look at PCA and ICA. We'll look at engineering our own features and enriching that as much as we can with third-party data where appropriate. As you move into regulated lines of business, though, you get much more restricted into how you can treat customer data, what's the appropriate kind of way that you can demonstrate what you're doing with that data as well. So naturally, transformations tend to be much more simpler, just because the ultimate the end of the road, we need to remember that we need to be able to explain that not just internally in the business, but to our external regulators as well. So you kind of always have to trade off the two of kind of benefit to the model. What benefit is it bringing versus kind of complexity and how easy that is to demonstrate and to be explainable.